Managing your finances effectively in your 20s lays the foundation for a secure and prosperous future. As you transition into adulthood, you may face new financial challenges, such as student loan repayment, building credit, and planning for retirement. Navigating these challenges can be overwhelming, but developing smart financial habits early on is crucial for long-term success. In this video, we will discuss the top 10 financial tips for adults in their 20s, covering essential aspects such as budgeting, debt management, investing, and insurance. By implementing these strategies, you can take control of your financial future and set yourself on a path towards financial independence and stability. 1. Create a budget. Creating a budget is a crucial step for young adults in their 20s to effectively manage their finances. A budget helps you understand your income sources, categorize your expenses, and allocate funds for different financial goals. By tracking your spending habits, you can identify areas where you can cut back and make necessary adjustments to live within your means. Regularly reviewing and updating your budget will enable you to stay on top of your financial situation. Utilize budgeting tools or apps to simplify the process and make it more convenient. Share your budgeting goals with family or friends to increase accountability and motivation. Remember that budgeting is not about depriving yourself, but rather about making smart financial decisions and prioritizing your needs. 2. Build an emergency fund. Building an emergency fund is essential for financial stability and peace of mind. This fund should cover at least 3 to 6 months of living expenses, providing a safety net in case of unforeseen events like job loss, medical emergencies, or car repairs. Start by setting a specific savings goal and contribute to your emergency fund consistently, even if it's a small amount. Consider keeping your emergency fund in a high-yield savings account for better returns and easy accessibility. Avoid dipping into your emergency fund for non-emergency expenses, and replenish it as soon as possible if used. Periodically reassess your emergency fund to ensure it keeps pace with your changing expenses and lifestyle. Remember that having an emergency fund can help you avoid taking on high-interest debt during difficult times. 3. Pay off high-interest debt. Prioritizing the repayment of high-interest debt, such as credit card debt, is essential for improving your financial health. High-interest debt can quickly accumulate and become overwhelming, making it difficult to achieve other financial goals. Develop a debt repayment plan by listing all your debts, organizing them by interest rate, and focusing on paying off the highest interest debt first. Consider using strategies like the debt avalanche or debt snowball method to stay motivated and organized during the repayment process. Make more than the minimum payments when possible, and avoid taking on new high-interest debt. Refinancing or consolidating your debt may be an option to lower your interest rates and simplify repayment. Remember that being debt-free will ultimately provide you with more financial flexibility and security. 4. Start investing early. Starting to invest early in your 20s can significantly impact your long-term financial growth. Compound interest works in your favor when you start investing early, allowing even small contributions to grow substantially over time. Begin by educating yourself about different investment options, such as stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Consider a diversified investment strategy to minimize risk and maximize potential returns. Low-cost index funds and ETFs can be a great starting point for beginners due to their simplicity and broad exposure to the market. Make investing a regular habit by setting up automatic contributions from your paycheck or bank account. Remember to periodically review and rebalance your portfolio to ensure it aligns with your financial goals and risk tolerance. 5. Contribute to retirement accounts. Contributing to retirement accounts, such as a 401k or an individual retirement account, IRA, is a crucial part of long-term financial planning. These accounts offer tax advantages that can help your savings grow more efficiently over time. If your employer offers a 401k plan, take advantage of any matching contributions they provide, as this is essentially free money. If you don't have access to a 401k, consider opening an IRA, such as a traditional or Roth IRA, depending on your income and tax situation. Aim to contribute as much as you can to your retirement accounts, keeping in mind the annual contribution limits. Regularly review your retirement savings progress and adjust your contributions as needed to stay on track. Remember that starting early and contributing consistently are key factors in building a substantial retirement nest egg. 6. Build good credit. Building and maintaining good credit is crucial for securing favorable interest rates on loans and credit cards, as well as for renting an apartment or even landing certain jobs. To build good credit, ensure that you consistently pay all your bills on time, as payment history is the most significant factor affecting your credit score. Keep your credit utilization rate low by using only a small portion of your available credit and paying off your credit card balances in full each month. Regularly monitor your credit report for errors or signs of fraud and dispute any inaccuracies promptly. Limit the number of new credit applications and avoid closing old accounts, as the length of your credit history also influences your credit score. Develop responsible credit habits early on to establish a strong credit foundation. Remember that a good credit score will make it easier for you to achieve various financial goals, such as buying a home or starting a business. 7. Maintain financial literacy. Maintaining financial literacy is essential for making informed financial decisions and avoiding costly mistakes. Dedicate time to learn about personal finance topics, such as budgeting, investing, credit management, taxes, and insurance. Stay updated on financial news, trends, and changes in regulations that may affect your financial situation. Utilize resources like books, blogs, podcasts, and online courses to expand your knowledge and develop your financial skills. Consider seeking advice from trusted financial professionals, such as certified financial planners, when faced with complex financial decisions. Engage in conversations about money and finances with friends and family to share experiences, tips, and ideas. Remember that being financially literate can empower you to take control of your financial future and achieve your goals more effectively. 8. Set financial goals. Setting both short-term and long-term financial goals is crucial for providing direction and motivation in managing your finances. Short-term goals may include saving for a vacation or paying off a specific debt, while long-term goals could involve buying a home, funding your child's education, or retiring comfortably. Be specific and realistic when setting your financial goals, and break them down into manageable steps. Regularly track your progress and make adjustments as needed, considering changes in your income, expenses, or priorities. Share your financial goals with loved ones for support and accountability. Incorporate your financial goals into your budget and allocate resources accordingly to stay on track. Remember that setting and working towards financial goals is an ongoing process that requires commitment, discipline, and adaptability. 9. Live within your means. Living within your means is essential for avoiding debt and building long-term wealth. As your income increases, resist the temptation to indulge in lifestyle inflation, where you increase your spending to match your higher earnings. Focus on keeping your expenses in check and prioritize saving and investing to achieve your financial goals. Cultivate mindful spending habits by distinguishing between needs and wants and making conscious purchasing decisions. Be resourceful and seek ways to save money on everyday expenses, such as using coupons, comparison shopping, or buying items in bulk. Create a long-term financial plan that takes into account your future needs and goals, as well as potential changes in your income and expenses. Remember that living within your means is not about depriving yourself but about making smart financial choices that contribute to a stable and secure future. 10. Protect yourself with insurance. Protecting yourself and your assets with insurance is essential for managing financial risks and ensuring your family's well-being. Health insurance is crucial for covering medical expenses and protecting your finances in case of illness or injury. Renters or homeowners insurance is necessary to safeguard your personal property and provide liability coverage in case of accidents or damages. Auto insurance is not only legally required in most places but also provides financial protection in case of accidents, theft, or natural disasters. Life insurance and disability insurance are important for individuals with dependents or whose income is essential to their family's financial stability, providing financial support in case of death or disability. Regularly review your insurance policies and adjust coverage levels as needed to keep pace with changes in your life circumstances and financial goals. Remember that insurance is an investment in your financial security and peace of mind, helping you navigate unexpected events with greater confidence. In summary, taking control of your finances in your 20s is essential for building a secure and prosperous future. By implementing the top 10 financial tips discussed in this article, including budgeting, debt management, investing, and insurance, you can lay a strong foundation for financial independence and stability. Developing these smart financial habits early on will empower you to navigate the challenges of adulthood with confidence and achieve your financial goals. Embrace these strategies and take charge of your financial future, setting yourself on a path towards long-term success and wealth.